The crypto market, once valued at over $4 trillion, was a beacon of hope for many investors. It plummeted in a historic crash on October 10th and 11th, 2025, sending shockwaves through the financial world. Over $370 billion vanished almost instantly, leaving investors in shock and disbelief. This wasn't a minor dip, it was a full-blown panic that shook the financial world to its core. The market cap dropped from $4.1 trillion to $3.33 trillion, triggering record liquidations and widespread fear. $19 billion in leveraged positions were forcibly closed in a single day, exacerbating the crisis. The crash was an external shock, catching everyone off guard and unprepared. The dream of endless gains was replaced by the harsh reality of financial loss. It was a brutal lesson in risk management and a wake-up call for the entire industry. Many investors faced their first major crypto bear market, a sobering experience for all. The crash wasn't just numbers on a screen, it was real people losing real money, affecting lives and livelihoods. The market's foundation was shaken, leaving a trail of financial devastation and uncertainty. It was a stark reminder of crypto's inherent volatility and the risks involved. The question on everyone's mind: what happened, and could it have been prevented? The crash was triggered by a sudden and unexpected government announcement that caught everyone off guard. President Trump declared a potential 100% tariff on Chinese imports, along with sweeping new export controls. The announcement was broadcast live, sending shockwaves through financial circles and making headlines around the world. This news sent global markets into a panic almost instantly. Investors, fearing the worst, began selling off risky assets like cryptocurrency and tech stocks at a frantic pace. The rush for the exits was immediate, creating a domino effect as panic spread from one market to another, amplifying the chaos. Investors scrambled to move their money into safer havens like U.S. Treasury, bonds, and gold, desperate to protect their wealth from the unfolding crisis. The selling pressure was simply too much for the crypto market to handle. Prices tumbled rapidly, wiping out billions in value within hours. Prices plummeted as sellers vastly outnumbered buyers, and the market seemed to be in freefall. To make matters worse, the U.S. government was in the midst of a shutdown, paralyzing key functions. Key regulatory agencies like the SEC and CFTC were closed, leaving the market without any oversight or intervention. This regulatory vacuum was disastrous, removing the usual safety nets that help stabilize markets during turmoil. Without regulators on duty, there was no one to halt trading, investigate suspicious activity, or enforce rules as panic took hold. The combination of a sudden geopolitical shock, widespread investor panic, and a total lack of oversight created a perfect storm of instability. It turned what could have been a bad day into a historic market catastrophe, the likes of which few had ever seen. The market was left to fend for itself during one of its most volatile and dangerous periods in recent memory. It was a toxic mix of fear, uncertainty, and inaction that led directly to a historic crash, forever changing the financial landscape. No coin was safe during the crash, but some were hit harder than others. Ethereum's price dropped by 21%, a huge loss for a major asset. Smaller coins like XRP and Pi Network faced even more brutal losses. The altcoin market experienced a bloodbath, with many coins losing 70 to 90% of their value. XRP suffered severe losses, following the trend. For investors, it was a terrifying experience. The rapid decline highlighted the risk of investing in less established coins. During a panic, investors sell their riskiest holdings first. Projects like XRP and Pi Network faced catastrophic declines. Leverage was a key factor in the crash's severity. Traders borrowed funds to make larger bets, hoping for amplified profits. When prices fell, losses were also amplified, leading to liquidations. This created a cascade of selling, pushing prices down further. The crash saw $19 billion in liquidations in a single day. Spot Bitcoin and Ether ETFs also played a role. Institutional investors redeemed ETF shares, forcing managers to sell Bitcoin and Ether. This added to the selling pressure, worsening the crash. The combination of leverage and ETF sell-offs created a perfect storm. As the dust settled, questions about insider trading emerged. A crypto wallet made timely moves before the tariff announcement, raising red flags. The trader profited over $150 million during the crash, With the government shutdown, the SEC couldn't investigate. Congresswoman Maxine Waters highlighted the lack of oversight. The market was a wild west, with no protection for investors. The shutdown allowed insiders to exploit the system. Many investors felt cheated, suspecting foul play. The incident underscored the need for regulation. After the crash, experts from around the world debated the market's future, analyzing data and sharing their insights on what might come next. The most likely scenario, according to many, is a sideways market for 2 to 3 months, as investors wait for new catalysts and confidence slowly rebuilds. During this period, prices would likely stabilize, with Bitcoin fluctuating between $95,000 and $135,000, reflecting cautious optimism. However, a bear case suggests further declines could occur if institutional investors continue pulling out, leading to more volatility and uncertainty. In this scenario, Bitcoin could drop to a range between $60,000 and $85,000, testing the resolve of long-term holders. On the other hand, a bull case sees ETF inflows pushing Bitcoin to new highs, as renewed interest and positive sentiment drive prices upward. Key indicators to watch include ETF net flows, macroeconomic factors, and shifts in global investor sentiment. A weaker dollar and lower yields would benefit crypto, making digital assets more attractive compared to traditional investments. The derivatives market and SEC actions will also play a crucial role in influencing the market's direction in the coming months. Despite all the uncertainty, there's hope for recovery, as markets often rebound after periods of stress. The crash was a necessary deleveraging, clearing excessive risk and setting the stage for a healthier market environment. Many investors still believe in crypto's long-term potential, seeing this as an opportunity to build for the future.